Hi, everyone. I hope you're having a nice Friday evening. This is Marie from MarketsFlow. It's the 18th of October, and we're recording this 2 hours before the close on Friday as we bring you this weekly performance for the week ending October 18th, 2019. I'm here with Adam today. How has your day been, Adam?
Oh, it's been good, thanks, Marie. It tends not to get boring in financial markets anyway, but at the moment we have the added ingredients of earnings season and a lot of expectation around economic slowdown and central banks.
Yes, it seems to be an interesting time in the markets at the moment. Right, so let's get started with today's webcast. This is webcast 25 for MarketsFlow's portfolio performance for week ending October 18th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is an FCA-authorized robo-advisor and digital wealth manager. We are also SEC authorized. Your deposits are protected by the FSCS for up to £85,000. Before we start, I would like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. So, Adam, how did the portfolios do this week?
Well, up to now, and as you said, we're not all the way through Friday yet as we speak, with a couple of hours to go before close. But the situation is high growth is up 0.12% this week, and that's up 6.88 since the launch of accessible portfolios in very early June. The equivalent figures for growth are 0.2% this week and 7.33 from early June. And for ISA, 0 this week and 4.38 for the period since early June.
And how has the market as a whole performed this week?
Well, at this time that I did that measurement for the portfolios, the markets, meaning, as usual, the S&P 500 was up 0.45% measured from last Friday's close. And in terms of the way the market performed this week, it's probably also worth adding that the whole week, the S&P 500 stayed within a fairly tight range of about 1.5% between highest and lowest. So as you'd expect in that sort of environment, implied volatility has been pretty low. There have been quite bullish and quite bearish periods during the week, often both within a single day. But in terms of the market making a lot of progress one way or the other over the whole week, it hasn't done so. It's been tight.
So what about the allocation within the portfolios?
Well, we were not very active this week in terms of the level of allocation, rarely getting up as high as 50% and mostly being a lot lower than that.
Mm-hmm. And you mentioned a narrow range in the markets. How did that affect the way the portfolios were invested?
Oh, that's a great question. But I don't have a particularly exciting answer. But, I think you could also split the issue down a bit further too. One aspect is the equity market an aggregate moving in a narrow range, which it has been. What that tends to mean is it's difficult to make much money through either buying and holding a portfolio that's representative of the overall market or through varying your exposure to the overall market, because it simply isn't moving around enough to add a lot of value that way. Another issue is it can be that if that range-bound market aggregate also is reflected internally in having sectors and stocks which are also dominated by range-bound behavior. And if in addition to that, there's also tight dispersion across sector performances or tight dispersion across the stocks within each sector, then it even further constrains any attempts to add value through having a sector tilt or picking the right stocks. And there are other characteristics that can also make the situation more fruitful or less fruitful for adding performance, such as whether trends are able to form with any kind of persistence at the stock level. And if not, then that's a further reduction in opportunity, because each position that's put on is then limited in terms of how far it can go. So you either put on more positions to try to make up for less contribution by each one, or if you don't have very much signal strength backing those positions, or just try and speak in less quantitative jargon, if you have less conviction about the likelihood of success of each position, then really the risk-aware or a prudent approach to coping with that is to put on fewer positions and wait for the more generous market regime that's probably waiting just around the corner. Don't accept lower quality of trades just in order to have a larger amount of them. But so to answer with respect to the week that we're in right now, the opportunity on most of those fronts that I just mentioned was quite limited, and without strong indicators of good risk-reward prospects, we reacted, I think sensibly probably, by being less active than we would otherwise have been. We were also slightly affected by the fact that being an earnings season, various stocks that we might have had within our remit were reporting earnings, and others are about to in the coming week. So we tend to shy away from being involved in a stock at those times.
That's very interesting, Adam. And what do we look forward to from here over the next week or two?
Well, I mentioned earnings. We're in that period now. It looks as if more companies are beating expectations rather than undershooting them so far. But I'm wary of forming an overall picture too soon, because we haven't really had a large or balanced sample of companies across all sectors yet. This is quite early days within the earnings season. What else? Lots of anticipation around monetary policy meetings with hopes and expectations of more easing. And obviously the various economic data releases, which are going to slowly, add to the picture as to how much various economies are slowing down. We're only, a few weeks away from getting a glimpse of the first estimates of third quarter GDP figures. So expect plenty of news coverage on what they say, whether good or bad. There's also Brexit unfolding from one day to the next, 1 hour to the next. It looks as if the risk of no deal may have receded. Let's see if Boris Johnson's deal makes it through UK Parliament. Also, we are just getting to that time of year when historically there have tended to be more volatility shocks than usual. It doesn't mean there will be, it's just a statistical fact. So perhaps that's also something to bear in mind.
That's great, Adam. Thank you so much for giving us all this information. So that brings us to the end of our webcast. Thanks for watching or listening to us on YouTube. And please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's webcast. Take care.